You bought the house, you signed the papers, you did the thing everyone said was the goal, and now you have a mortgage that is $2,329 every month for the next 30 years, and an uncomfortable feeling that you don't fully understand what you just agreed to. In month one, you send 2,329 to the bank. 2,042 of it goes to interest. $287 goes to your actual balance. You paid 2,029 and you own $280 more of your house. The bank collects $2,042 for the use of its money, and then month two begins and the process repeats. This is not a mistake in the paperwork. This is the design. The bank gets paid first, every month, on a sliding scale that takes years before the math meaningfully tilts in your direction. Most people make the payment, file the statement, and don't look at the breakdown. You look at the breakdown, and then you ask the question that changes the next 30 years of your financial life, which is, what happens if I pay $500 more than this every month? The first extra payment doesn't feel like anything. 2,829 instead of 2,320. The house looks the same. The neighborhood looks the same. Nothing announces itself. You get no confirmation that what you just did mattered. You just can't see it yet. What the $500 does is go directly to your principal, to the actual balance you owe, not to the interest the bank is charging you on that balance. Every dollar that reduces your principal today reduces the interest you'll owe on that balance for every remaining month of the loan. The savings don't show up this month. They accumulate in the background, invisible, compounding forward across years you haven't lived yet. You keep paying. You don't miss a month. The house needs a water heater in year two, and there's a stretch in year three where the $500 feels genuinely difficult, and you pay it anyway, because the habit is calcified, and calcified habits don't respond to difficult months. You pay it because it's what you do now. By year five, you have paid your balance down faster than the bank's schedule anticipated. You don't celebrate this. There's nothing visible to celebrate. The house looks the same. Your payment looks almost the same. But underneath the surface, the loan is shorter than it was when you started, and the shortening is accelerating because every extra payment you've made has reduced the base that future interest is calculated against. This is the mechanic that most homeowners never see and banks never advertise. You are not just paying down the balance, you are shrinking the denominator that generates the interest charge every single month going forward. The $500 you paid in month one is still working for you in month 60 because the principal it eliminated never generated another dollar of interest for the remaining life of the loan. The bank designed a 30-year amortization schedule because 30 years of interest payments is very good for the bank. The $500 is you deciding that the bank schedule is not your schedule. You are 10 years in. You've made the extra payment every month without missing once. Your remaining balance is meaningfully lower than your neighbors, who bought the same model house in the same year on the same street and has been making the minimum payment faithfully every month. Your neighbor is not doing anything wrong. Your neighbor is doing exactly what the contract requires. You are doing something the contract did not require, and the difference is beginning to show in the numbers in a way that will compound dramatically from here. This is also where something changes in the way you relate to the house. It is no longer a liability you're managing, it is becoming yours. Not on paper, it was always yours on paper, in the way it feels when you walk through the front door. The debt is lighter, not gone, but lighter. You feel the difference. You are in year 15 of a 30-year mortgage that is no longer going to take 30 years. The extra $500 every month has been doing work you didn't fully understand when you started. It hasn't just been reducing your balance. It's been buying back years. Years of payments, years of interest, years of being obligated to a bank for a fixed amount every single month, no matter what else is happening in your life. At this point in the simulation, you are on track to pay off your mortgage in year 20, not year 30. Year 20. You are going to reclaim 10 years of 20,329 monthly payments, more than $279,000, that you would have spent in years 21 through 30 if you had followed the bank's original schedule. That is the number that most people never calculate because most people never ask the question that produced it. The final year arrives. You make your last payment. The mortgage is done. You are not 65, the age the bank schedule assumed you'd be making your last payment. You are 55. You have a decade of working years ahead of you and a monthly housing cost that just dropped from $2,829 to whatever your property taxes and insurance run, a few $100s at most. You have freed up approximately $2, 500 every month that was previously spoken for. It is now yours. Sit with that for a moment. $2,500 a month, every month, for 10 years. That is $300,000 cash flow that exists because of a decision you made 20 years ago to pay $500 more than the minimum on a mortgage that felt overwhelming on the day you signed it. You didn't earn that $300,000 at a job. You manufactured it by refusing to spend the full 30 years paying a bank for money it lent you, and here's the number that anchors everything. Over the life of a $350,000 mortgage at 7%, the standard 30-year schedule costs you $488,000 in total payments. You borrowed $350,000 and you pay back $488,000. The difference, not $138,000, is pure interest, money that built nothing for you. Money that left your account every month for 30 years and made the bank larger and your balance smaller and your future no closer. The $500 extra per month eliminates roughly $139,000 of that cost and 10 years of that timeline. You paid more every month for 20 years to pay less overall and finish early. That is the trade. It sounds obvious when you write it out like that. Most people never make it because the $500 feels like a sacrifice today and the $139 Zoo Zero Zune feels like a theory about the future, and the future is always losing that argument until suddenly it isn't. The people who chose not to pay extra are not wrong. There are legitimate arguments for taking the $500 and investing it instead, and in certain rate environments that math wins. But those arguments live in spreadsheets. This story lives in the feeling of making a final mortgage payment at 55 when everyone around you expects to be making theirs until 65. It lives in the decade of $2,500 monthly cash flow that you can invest, spend, give away, or simply hold as the buffer that makes every other financial decision less fragile. It lives in the weight of the house feeling different, not the house itself. The weight, you started with a $350 Zilzin mortgage that was going to take 30 years and cost $488,000. You paid $500 extra every month. You finished in 20 years and paid $349,000. The bank got $349,000 on a $350,000 loan. You gave it almost nothing above what you borrowed because you refused to let the interest accumulate across the decades it was designed to accumulate across. That's not a financial strategy. That's a decision made once and repeated without drama for 20 years. The house was always yours on paper. Now it's yours the other way too, the way that doesn't require a monthly payment to maintain, the way that no job loss or rate change or market crash can reach, the way that belongs entirely to the 20 years of $500 decisions that nobody saw you make and nobody congratulated you for. You made them anyway, every month. And the house and the decade you got back and the $300,000 in freed cash flow, all of it is the receipts.